Let's jump right into it. Welcome to this explainer. Today, we're putting Century Communities, ticker CCS, under the ultimate microscope. We're going to run a full-blown institutional-grade stress test on this stock. Using real, hard data from their Q1 2026 filings, let's see what we're really dealing with. Here's our game plan. We'll start with a quick company snapshot, then view the stock through the eyes of absolute legends, Warren Buffett, Peter Lynch, and Benjamin Graham. After that, we'll crunch the raw cash flows with a DCF and some alternate models, and finally, wrap it all up with a definitive recommendation. All right, Section 1, Company Snapshot, Establishing the Baseline. So Century Communities is an affordable home builder currently operating across 16 states. Right now, it's trading at exactly $63.25. But you know the old saying, right? Price is what you pay, value is what you get. The real question we have to answer is, at $63, are we looking at a hidden bargain or just a classic value trap? Let's look under the hood. Their balance sheet shows total assets of roughly $4.5 billion, stacked up against a total stockholders' equity or book value of $2.55 billion. Add in a $1.82 billion market cap, $4 billion in trailing revenue, and an EPS of $4.45. And wow, on the surface, this actually looks like a massive enterprise trading at a really notable discount to its underlying equity. Moving on to Section 2, the Buffett lens. This is where we hunt for unshakable quality and that elusive economic moat. The very first question Warren Buffett would ask is, does this homebuilder actually have an economic moat? Can it fend off the competition? Well, in an industry famous for low barriers to entry and brutal pricing pressure, it's tough. Even in their own 10Q filing, they admit they have to constantly fight for land, labor, and buyers against rivals who can easily build similar homes. So honestly, if a moat exists here at all, it's incredibly narrow. And looking at this checklist, CCS really struggles to meet Buffett's demands. You know he loves a high return on equity and low debt, right? Well, Century Communities has an ROE of just 5.17%. Ouch. Plus, they're lugging around $1.54 billion in total debt, compared to just $78 million in cash. And to top it off, earnings aren't exactly compounding. Net income actually dropped 38% year over year in Q1 2026. For a Buffett-style investor, these are immediate glaring red flags. We can also try to estimate their proxy owner earnings. If we take their 5.89% trailing 12-month free cash flow yield and apply it to the market cap, we get roughly $107 million. But even with that decent cash generation, Buffett would almost certainly pass on this stock entirely. The lack of a durable competitive advantage, that low ROE, and the heavy debt burden, it's just a deal breaker for the Oracle. Let's switch gears. Section 3, the Lynch lens. Here we're focusing on growth, categorization, and finding a reasonable price. Peter Lynch famously sorted companies into 6 distinct buckets, and he would instantly slap a cyclical label on CCS. Homebuilders are notoriously tethered to the macro environment, things like mortgage rates and housing affordability. And Lynch always warned us, with cyclicals, timing is absolutely everything. The classic playbook is to buy when earnings look terrible and PE is high, and sell when earnings are peaking. Now, Lynch loved the PEG ratio, price to earnings relative to growth. But with that recent 38% drop in net income we mentioned, historical PEG kind of breaks down here. So let's assume a normalized 5% cyclical growth rate. Against their current PE of 14.2, that gives us a PEG ratio of 2.8. Lynch usually wanted a PEG around 1 for his fast growers. Sure, the rules bend a bit for cyclicals, but a 2.8 PEG, that is definitely not screaming cheap on a growth basis. But here's where it gets super interesting. Lynch's secondary checks show a really fascinating conflict. He always preferred low institutional ownership to avoid crowded trades, but Wall Street practically owns this thing at a massive 92.42%. On the flip side, though, he absolutely loved insider buying. And look at this. Insiders hold a very bullish 13.89%. Management definitely has some serious skin in the game here. Ultimately, Lynch's verdict comes down to macroeconomic timing. It's not a fast grower, and it's heavily corroded by institutions. So despite that awesome insider ownership, the highly cyclical nature of the 2026 housing market makes this a hold. It's just not a definitive buy for his aggressive, growth-oriented style. All right, Section 4, the Graham lens. Let's dig into some deep value and margin of safety. Benjamin Graham was famously obsessed with downside protection. He'd run a company through his rigid, step-by-step defensive checklist. He wanted large, somewhat boring companies with stable earnings, a solid dividend history, and, crucially, really low valuation multiples. Let's see how CCS holds up. Let's grade it out. Adequate size? With $4 billion in revenue, that's an easy pass. Earnings stability? Yep. Despite the recent dip, they're still highly profitable. Dividend record? They pay out $1.28, so pass again. Moderate PE? At 14.2, it's comfortably under his limit of 15. Price to book? This is the kicker. It's sitting at just 0.71, well below his 1.5 maximum. Trading this far below book value with a modest PE means CCS passes Graham's defensive filters with flying colors. Now let's run the math on his legendary intrinsic value formula. The square root of 22.5 times EPS times book value per share. Punching in there 4.45 EPS and 88.75 book value spits out a massive intrinsic value of $94.26. With the stock currently sitting at $63.25, we're looking at a huge 32% margin of safety. Graham would absolutely love this setup. Section 5. DCF Valuation and Alternate Quantitative Models. Let's pivot from philosophy to pure, hard math. To build our discounted cash flow model, we need our base assumptions. We're starting with about $107 million in free cash flow and applying the company's weighted average cost of capital, 6.44%, as our discount rate. Now, considering the macro headwinds, affordability issues, and that 12.6% revenue decline they just reported, we're going to be super conservative and assume a 0% growth rate over the next 5 years, followed by a standard 2% terminal growth rate. When we run a sensitivity table, just slightly tweaking that discount rate and terminal growth, it reveals a fair value range between $60 and $80, which is wild because that aligns almost perfectly with the current stock price of $63.25. Basically, the pure math is telling us the current market price is already pricing in a no-growth, steady-state future for the business. Checking some alternate models pulls the story in two completely different directions. The dividend discount model totally punishes CCS for its low payout ratio of just 27.44%. It essentially says the value is lower because they aren't aggressively returning cash to shareholders. But then, if you look at comparable price-to-book multiples against its peers in the sector, trading at 0.71 times book makes it look like a blatantly undervalued anomaly. Which brings us to Section 6, Synthesis and Final Recommendation. Let's pull all these threads together. Our final matrix really highlights the split personality of this stock. Buffett passes entirely due to the lack of a moat and weak ROE. Lynch sees it as a cyclical hold, totally dependent on timing the housing cycle. Our DCF model also spits out a hold, putting the stock squarely in fair value territory. But then there's Graham, screaming buy, pointing to a massive margin of safety and a $94 intrinsic value. The takeaway? Quality and growth investors are walking away, but deep value investors are staring at a tremendous opportunity hidden in those underlying assets. So here's where we land. Century Communities is generating cash, paying a dividend, repurchasing shares at a discount, and sitting on a huge discount to book value. That book value is your shock absorber, but you have to ask yourself, are you prepared to ride out the cyclical storm of fluctuating mortgage rates and affordability pressures? Is its 32% margin of safety deep enough to justify the wait? That's the puzzle you have to solve. Thanks for joining me for this explainer, and remember, always keep questioning the value behind the price.